Hey, Sean from Vesta Live again. So today I want to talk about a topic that I happen to really love, and that's the idea of rental properties and how I run REITs in tandem with my rental properties to help develop more income, more asset growth, more potential to grow my real rental profile into more properties and get more doors. And sort of some of the ways that I take advantage of this with my business partner in our small investment firm around real estate. But first, let me start here as always. I'm not a licensed financial advisor, and everything I'm talking about here is really my opinion and how I do things. There's always risk anytime you invest in real estate or the stock market. Just want to get that out of the way, of course. And then please, if you find value here, subscribe to our channel. We're going to have a lot more videos on the way. And hit that like button for us. It really helps us out a lot. So let me give you a little background. Um, I invest in real assets like rental properties. Typically, I look for single family homes. And the challenge of investing in hard assets like real estate is there's just a lot of money that you have to have up front to make that work. So one of the things that we've tried to do is come up with a plan that will help us to sort of expand upon the income and margins that come from those rental checks every month while also thinking about things like expenses. So I'm going to keep this pretty simple, but I'm happy to go into details if questions in the comment section pop up. And frankly, I would encourage you to ask any questions you have there. So here's the way we started. Going back some time now after the '08 financial crisis, we saw that there was a lot of value in investing in asset classes that had been hit pretty hard from the financial collapse. So what we did was we gathered what we had for money at the time, and granted, this is now 12 years ago, and we went down to Memphis, Tennessee as a place to start because home values were pretty low, rents were still pretty good, and we could provide a really nice living experience, clean homes, updated features within the home, and still keep the rent really low, but have a good profit margin on there. And so that's sort of one of the things that we found to be really important was we weren't looking to maximize profit on our rental properties. We were looking to maximize a safe place for people to live who don't necessarily make a lot of money. And for those who don't know, this is what we typically call affordable housing. As a small firm, we take this really serious. We want to make sure we're providing good, healthy places for people to live in affordable incomes. So here's the thing though. As you pick up your first property and you're new at this and you're buying sort of in that lower tier of pricing, right? It's important to realize that you're not going to make enough every month to be able to buy a new property right away or in a couple of months. And typically with lower priced properties, the appreciation rate is going to be a bit lower than with higher end properties on the coast or in major cities like New York City, Boston, or San Francisco, or LA perhaps. So what we realized is we wanted to really focus on real estate while we grow this little business. And the way we wanted to do that was to start leveraging things like REITs and mortgage REITs, which sometimes are called MREITs. Now, a REIT is a real estate investment trust. And what this really is a tax designation for companies, we're talking about publicly traded in this case, that invest their assets in large scale real estate. It could be 50,000 single family homes or apartment buildings or industrial properties or healthcare facilities, you name it, it's whatever you want it to be. And then also mortgage REITs, which basically invest in the mortgages that back those loans. So we had this plan that rather than try to sit and just put that money into a savings account, what we were going to do is actually leverage REITs as sort of an extension of our real estate portfolio. So it all started with having one rental property with a good margin of profit on that rental every month. So say we made $250 in profit per door. We would then take that $250 and put it into the markets via a brokerage account and buy REITs with it. And what we tried to do was typically go as diversified as we could, leveraging both ETFs and specific stocks. So we wanted to have a good bundle of, residential rentals, commercial rentals, industrial rentals, the whole shebang. And we also want to have a little bit of a mortgage REIT exposure as well. So what we would do is every month use a little bit of that profit to buy a little bit more of the REITs. Those REITs typically then also kicked back either monthly or quarterly dividends. Now, the way we treated that was those dividends just add to our profit margin on the main property. So as we're saving and reinvesting, we're taking that monthly payout from the single families. We're growing our assets, which are then producing more income off of those assets. What this is able to do is help us accelerate two different things. Number one, our free cash flow every month, which is really important as we're growing a small business. But number two, it helps us to grow our savings so we can buy more real property. So as we get to a point where we can suddenly put down another 20 or 25% to buy another one, we liquidate and buy another real property, and we double down again. But this time you'll have two doors renting with perhaps two $250 profit checks per month. So, as you see here over time, this starts to become really an engine of get a rent check, put it into REITs, reinvest those dividends. You see the growth get even faster on the equity side, cash out, buy another property. Now it's times 3 or times 4. Now, if you're saying to yourself, look, this sounds great, but I don't even have enough for a 20% down payment to get my first property. Totally cool. And I actually get that. And this is the sort of the same place we started out way back when, around the 2000 timeframe when I got started in the markets. So what I would suggest doing is find some REITs that you like, do your research, be thorough. I actually have another video I posted about how I like to do research, but take it a little bit further than you would normally as you just invest in a normal equity in the stock market. Really give yourself the feel that you're investing in those assets yourself and you hold them for real, not just a stock. What I want you to do is think about it like this. Check in on the tenants that are sitting within that REIT. If it's a commercial REIT or a retail REIT, you know that they have shopping malls. Are those shopping malls doing well? Do your research on it. Understand what malls are trending. If you're investing in a REIT that's heavily into single family markets, understand where they have those homes, how they're performing, what the maintenance costs are, what kind of margin they have on that every month. And really treat it like it's your own business. Call investor relations. Call and see how the numbers look. Do constant news searches and RSS feeds. And the idea here is, as you're prepping towards getting your first real property that you own with that physical asset, and perhaps using a property manager, this gives you a little bit of experience in how to look at tenants, how to understand profit margins, how to understand your cash flow. It sort of gets you in that mental game ahead of time to be prepared for that first buy. And you already know what you're looking for. You understand the kind of margins your competitors will have. In my case, because we look at single family homes, when we look out there to understand what we want to buy, we go and we look at the big REITs in the single family space. We want to know what they're paying for homes, what their margins are, what their costs for maintenance per square footage is, and what their rehab costs are like. This way we can sort of know very quickly, are we sort of staying with the pack? Are we competitive? Even though we're a small firm, are we able to get numbers that are pretty close to what they have? And for us, that's really important, because when it comes time to liquidate, we want to make sure that we're in a place where we could potentially go to a big REIT or a hedge fund or an asset manager and sell our portfolio to them directly. Or realistically, what we really want to do is hold long term and have lifelong cash flow. So that's it. Short video. I'll recap quickly here. We leverage things like REITs and mortgage REITs to hold our profit from our actual rental checks as a way to both grow the assets but increase the monthly cash flow. We then take that when it hits a certain point, 20% down, 25% down of another property, we'll liquidate and buy more real estate. So that's it. That's just one way of doing this. And again, this is just our suggestion. But if you want to hear more things like this, please comment below and ask me some specific questions. I'd love to answer them. And then on top of that, we have lots more coming around this topic, so please subscribe. Other than that, have a great day.